Welcome back to Investing Talk Podcast. Today we are focusing all of our energy on the skies of tomorrow. We're tackling a question that has been lighting up our inboxes and really dominating market chatter lately. Is Archer Aviation a good time to buy now? Before we unpack this high-flying stock, we really encourage you to subscribe, like, and comment on this analysis. And hey, if you have a specific company you want us to look into next, please do leave a comment below. Your input really does drive these explorations.
Absolutely. And our mission today is, well, to give you a comprehensive analysis. We are sifting through, the latest financial filings, analyst reports, market movements, everything we can find. The goal is an impartial overview of Archer Aviation's prospects right here in mid-October 2025. And let's be clear, you're investing in a pre-revenue sector. High risk, yes, but also potentially revolutionary reward. Electric vertical takeoff and landing, or eVTOL.
Okay, let's unpack this development stage company then. Archer Aviation's whole story, it really hinges on navigating regulation and achieving that tech leadership in eVTOL. What's the single biggest recent thing, the development that sort of validates their technological edge?
Well, what's fascinating here is their strategic focus on intellectual property. Back in September, Archer announced they acquired a pretty substantial patent portfolio from Lilium. Lilium's a key European competitor, They paid approximately $20.8 million for it.
Wow, $20 million just for patents. That feels like a lot of dry powder for defense, maybe not development. What did they specifically buy? And why did the market just sort of yawn? We only saw a slight increase in the share price then.
Yeah, that's where the nuance comes in. They acquired a portfolio covering critical structural elements and also certain noise suppression technologies, really specific stuff for their aircraft design. This move, it explicitly reinforces Archer's leadership game in the U.S. It helps insulate their design against, future legal fights. The market didn't explode because, frankly, investors are a bit cynical about IP until the FAA actually says the plane can fly. They want regulatory news, not legal defense, even though, well, one is needed for the other.
Okay. That makes sense. So a necessary hurdle cleared, but maybe not the most exciting one for the market right now. Beyond this patent move, what else was going on late summer, early fall?
We saw continued focus on tech advancement, flight testing. That was through August. More importantly, October saw really active investor relations, constant updates on their progress towards certification. They're trying to manage expectations, keep that commercial narrative alive. Lots of incremental updates on production partnerships, pre-order talks, that kind of thing.
Right. That brings us to the fundamentals, and this is where a lot of potential investors hit the brakes. We're looking at an aerospace company still in pure R&D. If we look past the blueprints, what do the books actually look like? What are the core financial facts here?
Yeah, this raises that big question about valuation, doesn't it? Fundamentally, Archer Aviation is pre-revenue. Commercial service hasn't launched yet. Looking at the trailing 12 months ending June 30, 2025. Zero revenue reported. And consequently, they posted a staggering net loss of $612.80 million.
Oof, that loss figure is massive. For our listener, can you put that $612 million burn rate into context? What was most of that money spent on? And how long can they keep that up?
Think of it this way. That's roughly $1.7 million burned every single day for the last year. It's R&D, tooling, certification costs, building out manufacturing. It's the price tag for developing brand new aviation tech from scratch. Now, how long can they sustain it? Well, as of June 30, 2025, they had about $407 million in cash and equivalents on hand.
Okay, so cash is just over half the annual burn rate. That gives them a runway, but it also means the clock is ticking incredibly loudly, doesn't it?
Exactly. They operate with negative free cash flow. Cash is going out way faster than it's coming in. But look, that's standard for this development stage. On the plus side, their total liabilities position is moderate, around $263 million, and they have minimal long-term debt. Their financial strength really relies entirely on successfully telling and executing that story of transitioning from R&D to commercial operations.
And when do analysts or the company itself kind of expect that shift to actually start generating revenue?
Analyst estimates suggest revenue growth could begin as early as 2026. The whole point of this high spending right now is maintaining strong liquidity while front-loading all that R&D. It's all in anticipation of getting that crucial FAA certification and hitting commercial launch volume.
Okay, let's pivot a bit from the balance sheet to the competitive landscape, because the eVTOL space isn't empty, right? You've got Joby, Lilium, others all racing to market. What's the key competitive edge for Archer? What sets them apart?
It really boils down to a mix of foundational support and market execution, I think. First, the product. They're developing the Midnight aircraft. It's specifically designed for rapid, high-volume manufacturing. But the real difference maker might be who they're partnered with. They've secured these foundational major partnerships that are just essential for commercializing and scaling up.
Which partners are the crucial ones for you, the listener, to really focus on?
Well, you look immediately at United Airlines. They're critical not just as the initial customer, but also for providing that commercial validation and those committed pre-orders, but maybe even more crucial for actually building these things at scale is the partnership with Stellantis.
Right, getting an automotive giant like Stellantis involved sounds great for production, sure, but
Yeah.
does that also create a risk? I mean, if Stellantis changes strategy or if United pulls back in a downturn, is Archer maybe too dependent on these two giants?
That's a critical point, absolutely. It balances the bullish view. Yes, they've essentially outsourced their production scale and expertise to Stellantis, aiming for that automotive-grade efficiency. But that reliance introduces execution risk that's outside Archer's direct control. If Stellantis hits production snags or, say, redirects its battery development focus internally, Archer feels that pain directly. So yes, this customer and manufacturing concentration risk is significant. However, for now, that strong support, plus their reinforced IP, plus their early U.S. regulatory position, it does create a pretty formidable first-mover advantage as certification gets closer.
Okay, let's move to the technical side then. We've established the fundamentals are, well, entirely future-based, built on hope and partnerships. But what has the price action actually been? What are the indicators suggesting for momentum right now, mid-October?
Well, the stock has shown exceptional momentum this year, really surged and went from a 52-week low of $2.99 up to a recent high of $14.62. That pattern is pretty consistent with strong bullish accumulation, especially in a year where the broader market, faced some headwinds.
That's a huge run-up. Are we hitting a ceiling now, or are the charts still showing signs of strength?
Still showing strength, actually. The stock is currently trading well above two critical levels. Its 50-day simple moving average, the SMA, which is at $9.96, and also its 200-day SMA at $9.55. Trading above those key moving averages, that generally points to healthy, longer-term bullish sentiment. However, the 14-day relative strength index, the RSI, it's neutral right now at 43.88.
Can you quickly remind our listeners what a neutral RSI means in plain English? Does that suggest big investors are holding back, or are we just not seeing that frenzy we saw earlier in the year?
Sure. A neutral RSI, basically between 30 and 70, means the stock isn't currently seen as overbought or oversold. It kind of implies a healthy consolidation phase rather than a buying frenzy. It suggests that while the stock might have room to run, the buying pressure isn't overwhelming right now. The market seems to be waiting for the next catalyst before pushing higher.
Okay. And what about the professional sentiment? We know institutional money is coming in, but how confident are the analysts looking at this?
Analyst consensus is a moderate buy. You've got 7 out of 9 analysts rating it a buy. The average price target is sitting at $13.43, which suggests about 13% upside from the recent close. Institutional ownership keeps rising. Key growth funds like ARK Invest are involved, which speaks volumes about confidence in the long-term trajectory. Although it's worth noting, no large insider buying was reported in Q3 2025. That might suggest current management sees the stock as fairly priced around these levels.
Right. Let's talk about that clock again. For a high-burn company like Archer, the next 90 days aren't just important, they feel almost existential. What specific dates must we mark on our calendars? Things related to cash burn, regulatory progress?
Oh, the calendar's packed. And, yeah, the next few months could really determine if they hit those 2026 revenue projections people are talking about. First up, the Q3 earnings report. That's scheduled for November 6th, 2025. It'll be the first big data point since the last update. Investors are going to need crucial updates on certification status, the size of that commercial order book, and, critically, a detailed update on their cash runway projection. How much longer can the current cash last? Second, and this is arguably the most powerful potential driver, FAA progression. We're anticipating either finalization or at least a major interim milestone for the Midnight aircraft certification before the end of the year. If they hit a regulatory milestone suggesting commercial flight approval is genuinely imminent, well, the stock could see a massive surge. That's the big one.
And are there any sort of scheduled market mechanics, things independent of the company itself that could still impact the price volatility?
Yes, definitely. Keep an eye on November 15th for the institutional buys announcement that shows how major funds shifted positions, and December 1st for ETF rebalancing. Because Archer is so volatile and often included in growth ETFs, those scheduled events can force price action as funds have to buy or sell shares to meet their mandates.
Okay, beyond those confirmed dates, This sector just thrives on speculation, doesn't it?
Yeah.
What are the sort of speculative catalysts that often get retail investors excited when there's no hard news?
Oh, the market chatter is relentless. You hear things like potential expansion into European or Asian markets. That would signal global ambitions, expand the potential market size. Huge, if true. There's also always ongoing speculation about maybe a breakthrough in battery technology. A lighter, faster charging battery would be absolutely transformative for the whole industry, not just Archer. And finally, you always hear whispers about additional Department of Defense or other government contracts, maybe pending FY26 budget approvals. Those contracts mean non-dilutive funding, high margins. Very attractive.
Right, but we have to balance all this optimism with reality.
Right.
What are the primary tangible risks that come with this generally bullish outlook?
The risks are really concentrated in two areas: execution and market dynamics. The most critical company-specific risks: timing of that FAA certification and successfully transitioning to scale manufacturing, especially using that huge Stellantis partnership. If those deadlines slip, it doesn't just delay revenue, it forces them to burn through more of that $407 million cash pile faster.
And focusing on that cash position again, what does the ongoing burn mean for potential future investors?
Yeah, the ongoing cash burn before revenue starts flowing, that presents the risk of future dilution. If they run low on cash and need to raise more capital, they'll likely issue more stock. That dilutes the value of existing shares. It's always the sort of sword hanging over a pre-revenue company. And furthermore, we absolutely have to address volatility. This stock has a high beta of 3.06.
Can you just clarify that high beta for our listener? What does 3.06 actually translate to in terms of trading risk day to day?
Sure. A beta of 3.06 essentially means the stock has historically been 3 times more volatile than the overall market. So if the S&P 500 moves 1% on a given day, Archer stock could historically move 3% in the same direction, up or down. For you, the listener, this is a big flag. It signals this is a highly speculative, high-risk position. It requires careful position sizing and risk management. You're basically accepting a potential roller coaster ride in exchange for those potentially massive returns.
Okay, so if we synthesize all of this, the leadership, the partnerships, these impending catalysts, but also the risks of execution and dilution, what's the overall investment thesis? Is now actually a good time to get in?
Well, based on everything we've looked at, the analysis provides an overall bullish rating of 8.5 out of 10. That high score is really justified by its clear leadership position in the U.S. urban air mobility sector, the strength of those Stellantis and United partnerships, and importantly, the concentration of critical regulatory and commercial milestones expected literally over the next 3 months. Plus, the technical indicators do seem to support near-term upside if they meet those deadlines.
So what does this all mean for you, the listener, trying to make a decision?
Like, Archer Aviation represents an early-stage aerospace investment. It's defined by high volatility, yes, but it's also rapidly approaching what looks like a critical inflection point, a point where the concept could transition into commercial reality. The potential returns are really tied directly to those confirmed milestones we talked about, like the November 6th earnings report and that pending FAA progress. But here's a final provocative thought for you to consider. Given that heavy reliance on the United Airlines partnership, how might a delay in the broader regulatory framework for the networks, the actual urban air mobility networks, not just certifying the aircraft itself, how might that impact Archer's high customer concentration risk in the short term? You really have to monitor the progress of the whole sky taxi infrastructure, not just the plane itself.
That's a really crucial point to watch, alongside that technical momentum. Remember, as always, do your own research, connect the dots between the regulations and the partnerships, and always, always manage that risk. Thank you for joining us for this investment analysis. We'll be back soon with another detailed look at the companies shaping tomorrow.